Hypothetically, if rates were to go down another 1% from today by April of 2025, that would mean at that point that qualifying power would actually increase because, as you know, you can qualify for only as much as the qualifying rate allows. Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow. So here we are a week later. You've had some time to reflect on the Bank of Canada's update. And the question I ask you today, more so than last week, was, did they do enough? Might be a shocking question to be asked at this point right now, but that's what some are asking. And in fact, some are asking the question if we're just now behind the eight ball and we're not reducing interest rates nearly enough to the point that it's going to have any effect on the economy. Now, unless you were hiding under a bed somewhere, had no access to internet or any person for 3 weeks before the rate update, October 23rd, 2024, BOC decided to reduce rates by 0.5%. And as you probably know at this point right now, that affects those who have variable rates and lines of credit or any debt based on prime. The two mortgage options with a fixed payment, you'll see less money going to interest. Or if you have an adjustable payment, depending on your amortization, you'll see around a $15 reduction for every $100,000. It equates to anywhere between $29 to $31 of reductions depending on your personal situation, but a nice bit of savings nonetheless. Now, the question mark around did they do enough is one that started to arise in the coming days after the Bank of Canada did the rate drop there to bring the overnight rate to 3.75%. And this question was first posed by RBC's Economists. A couple of notes regarding an article about the RBC Economists are suggesting essentially that they are looking towards December as seeing an additional 50-point rate cut to bring the overnight rate right down to 3.25% before a return to a gradual pace of easing in 2025. Now, most of the markets right now are predicting a rate reduction of closer to 0.25% for December, followed by another high chance of seeing another 0.25% rate reduction in January of 2025. Again, RBC may be the outlier in this case, but if you can recall back to a video and a podcast that I did just a few months ago, CIBC's economists at that time were suggesting a very similar outcome, getting interest rates down another 1.25% from where we were at that time, which would bring that 0.5% basically right on track for what they were predicting at that point. Now, looking at the notes, the overall neutral rate that is proposed is supposed to be anywhere between 2.25 to 3.25% from the BOC, and this would place things on track for the lower bound of those rate options. Now, of course, a question mark of whether or not that's too much too fast is going to be asked by many, and wondering if that's going to stimulate the housing market to a point at which it's really going to get things going and have a negative impact in the housing market. The flip side to that is if you haven't already heard the news, well, guess what? The Canadian Liberals are planning to shrink its population after the demand itself has already plummeted. You've heard that correctly. We've already seen a record growth in temporary workers and populations. Our country saw over 1.25 million people in just over 2 years, or some insane number, which was reflected obviously in rental rates and the housing economy as a whole, basically squeezing people into little mini rooms and sharing rooms together. And now they've come down and essentially suggested that they have a new immigration plan, and the policymakers are going to provide, basically they're going to come to the rescue of Canadians and provide a much more strict guideline around the immigration demand. Well, of course, they're a little bit too late on this one, and I think everyone can see through the noise and know that immigration demand was already plummeting as we were seeing people basically choose to leave the country. But the question mark remains, what does that mean for the overnight rate? What does that mean for the Bank of Canada? And what can borrowers expect in the real estate market in the coming months? Now, if you had been asked back in July, surveys suggested that most Canadians were waiting to see between 0.75 to 1.25% of rate cuts before they decided to hop back into the marketplace. Specifically, I saw a survey from back in September, and it talked about how many rate cuts would you want to see before you hop back in the market. And the average individual, the highest percentage of respondents, and it was a respondent poll of around 5,000 people, the average percentage of respondents suggested they wanted to see at least 0.75 to 1% of rate cuts before they were willing to hop back into the marketplace. And here we are, 1.25% rate cuts off the peak, putting most variable interest rates after the discounts around 5 to 5.25%, depending on if that's insurable or an uninsured mortgage, with some insured options, less than 20% down, now being sub 5% at this point right now. The question that we beg to ask is, okay, does that mean that those people that were responding to the survey, that high percentage of Canadians are now ready to jump back into the marketplace? Or with such a jumbo-sized rate cut, does that actually mean that more people are actually going to wait even further to see what happens in December? Depending on who you're talking to, many are suggesting the latter, that December now is where the market is going to see the rate cuts. And as a consumer, there's, I guess, two ways to look at this. They're not necessarily tuned into the real estate market per se from the same context and perspective as someone who's in it day to day like myself, or anyone in the real estate or financial space that deals with mortgage and real estate daily. You know, if they're seeing rates continue to cut 1, 2, 3, 4 times, why wouldn't they start to beg to ask the question, why not wait further? Why not wait a little bit longer? Let's see where rates go. Because I'm starting to believe that that is, in fact, what most Canadians are starting to think. Now, that doesn't mean that everyone's thinking that way. Anecdotally, myself, I saw activity pick up pretty significantly in the last 1 to 2 weeks, specifically for people getting accepted offers who were pre-approved or pre-qualified for months, and in some cases, even as much as a year, deciding that this is the time that they were ready to jump back into the marketplace. And does that necessarily mean that we're going to see an influx of a significant amount of activity? No, not necessarily. We're here in the end of October of 2024. Traditionally speaking, this is a time of year where we don't necessarily see a lot of new applicants, but it has been pretty steady going over the course of the last 30 days. So again, it begs the question, will we see more people rushing to the housing market? Will we see more multiples? Will we see people waiting? Well, I'll answer a few of those points right off the bat. Are we going back to the days of 2021, 2022 with lineups and multiple offers in the winter of 2024? The answer to that question is probably not likely. It might happen in some certain circumstances, and we have seen it happen in certain communities and certain cities where there have been multiple offers, but it's not a regular occurrence. And at this point right now, depending on which community you're in and what type of property you're trying to purchase, you generally speaking have the ability to negotiate with home sellers. The other side to that is many home sellers have decided to stay pretty sturdy on their house prices in a lot of markets, depending on where in BC or Alberta or Canada you are. But we have seen some become a little bit softer and offer more price negotiation. In fact, I was talking to a local real estate agent in the Fraser Valley of British Columbia, and they were showing me a report showing all the recent sales in the area, and it showed that almost all properties were selling under listing price. Now, I didn't get the percentage of under listing price that they were selling for, but that essentially says that there is room for negotiation and there are people purchasing real estate right now. I was also talking to someone who was showing me the stats, and the stats right now were showing that, specifically speaking, when we're talking about the Fraser Valley, the Lower Mainland, more properties have sold this month than 12 months ago before, but we've also seen a significant uptick in the amount of listings. Yet activity as a whole in October of 2024 is still historically low relative to the last 10 years in the marketplace. So short version, what that means is we're seeing more Canadians purchase real estate. We're seeing more activity in the marketplace, but nowhere near what we've seen historically speaking. And the question that you have to ask there is, are people still waiting for rates to come back down? And I think the answer to that question is yes. Now, does a 50-point rate cut make people take the plunge and get in the marketplace? Probably some. There's no doubt some, because they're starting to look at it and say, okay, the rate difference is coming down. We've seen fixed rates now pretty steady for the better part of the last month. And in fact, there was a little bit of upwards pressure on fixed rates. You still can't qualify for more money yet today, and so we're not going to see any real upwards pressure on house price at this time. Maybe I'm going to jump in right now and go in with what's a sure thing. as opposed to waiting to spring to seeing, well, what everybody else wants to do, which is wait for rates to come back down. But we also have that other side of the marketplace, which is saying the exact opposite. I'm going to wait till spring of 2025 when I know where rates are going to go. And hypothetically, if rates were to go down another 1% from today by, let's say, April of 2025, that would mean at that point that qualifying power would actually increase. Because as you know, you can qualify for only as much as the qualifying rate allows, which is 2% above the rate you're getting. And still at this point right now, if people are looking to qualify for a mortgage, they would typically still take a fixed rate because that's the lower of the two options. And so there's the fundamental point that most people don't realize as it relates to house prices, that those are waiting for mortgages, those people that are waiting for those loans are still waiting for a higher rate drop. Now, don't forget a few things that are about to happen, and this is where 2025 becomes very interesting, and today's news and today's information is just that much more impactful. In December of 2024, we're going to see CMHC's new rules take into effect as it relates to $1.5 million insured mortgages, 30-year amortizations for first-time buyers on any property, and 30-year amortizations on anyone buying a new development home, which those two factors alone will drive up demand to a degree. Now, the flip side to that is in 2025, we're going to see record amounts of renewals come up. The question mark is, are people going to sell? Are they going to struggle to make their payments? Are they going to refinance? I think that renewal situation will be nowhere near the issue that many are suggesting. But I want to lean back on what I suggested earlier, which was the demand consideration. With immigration numbers likely to decrease, if nothing else, by at least 50% based on what we've seen recently to under $400,000, which is probably where we should be, we're not going to have those extreme demand issues. Now, a lot are suggesting that's going to impact the housing market as it relates to resale values. I think what it does is actually impacts the rental values and maybe a subset of the real estate market. Specifically, inner city condos are going to probably have a big impact in their values, especially when there's less people renting out those types of properties. But demand isn't going to go down significantly because there's still a significant amount of people who want to buy and who live here. And it's been shown that people who are typically buying real estate that are immigrants are permanent residents or those working to be Canadian citizens as opposed to temporary residents anyways, who typically rent. So if there's any market that's likely to be impacted, and little heads up, we're going to have a great guest expert interview in one of the future podcasts on this, it would most likely be rent demand in certain cities where we are seeing a significant amount of completions, notwithstanding the fact that most residential resale builders flipped their properties, not most, but many of them have flipped their properties from residential resale to apartment rental condos in 2024. Rent demand itself, although still probably elevated, is not going to be at the insane numbers and see the insane growth that we saw in the years 2022, and obviously in 2021. So what else is happening in the marketplace, and what are the things that most Canadians aren't paying attention to right now? Well, one thing is the fixed rate piece that I just mentioned there. First and foremost, the fixed rates right now, and if you don't know this already, I'm sure you know this if you listen to any of my previous podcasts, but just as a revisionary conversation, fixed rates are based predominantly speaking on the bond yields, and the five-year Canadian bond yield is what most people look at as one of the primary indicators as to where fixed rates are going. Well, on Wednesday, that yield actually ticked up just a tiny little bit with a little bit more upwards pressure. And if you're wondering why that's happening, and we can do a deeper dive in one of our future podcasts, we've done this before, just follow what's happening in the U.S. 10-year Treasury. Whatever happens in the U.S. is basically what is happening in Canada, and it basically drags it up or down perfectly in a line. So just have a look at a 10-year U.S. Treasury versus a 5-year Canadian bond yield, and you'll have a better understanding as what I mean by that. But let's break down a few other key details of the mortgage aftermath. What actually happened, this giant nuke that, boom, dropped in the marketplace, that those are obviously seeing happen right now. Why did it happen? Let's talk about it here. So first of all, we talked about the fact that headline inflation's at 1.6%. That ain't good. It's not exactly where they want it to be. And they wanted to get it up to what we talked about, which is neutral, higher, around 2.25 to 3.25%. The outlook, which we touched on previously, right now for the marketplace is to bring that overnight rate down to somewhere around 2.75%. If you were to look at the overnight markets and where rates are looking to go. Other things to note right here is that we talked about the fact that Canadians with the floating rate mortgages are noticing a pretty significant difference. But don't forget this one factor right here is that the interest-only HELOC borrowers are noticing a significant amount of difference in their personal expenses to the tune of about $40 a month more back in their pocket for every $100,000 borrowed. And I think that is one part of this whole thing which is completely forgotten about and understated, which is the HELOC borrowers are just as impacted as the mortgage borrowers, and those are seeing a pretty significant drop. And we're going to see that, I think, have a noticeable impact on people's willingness to buy or invest or renovate their existing homes. As we mentioned, the fixed rate shoppers, you're not going to get any love right now. We talked about the fact that the bond yields dipped pretty significantly back in September and kind of really like flatlined and even saw a bump up in October with banks no longer offering those insane, significant, deep discounts that we were seeing for some time. But that's most likely short-lived, and it's most likely that we're going to see the bond yields continue to decline as we hit December or as we see things continue to move down in the U.S., although we'll wait and see what happens down there because, again, there's just such a wild card with what's happening in the United States. So as we talked about previously now, the margin between a fixed rate and a variable rate has shrunk significantly, which is, again, allowing people to, answer the question, should I go fixed or should I go variable? Should I roll the dice? It makes it a lot more enticing to roll the dice right now on a variable rate when the spreads are so much tighter because the payoff, which could potentially be there, the calculated gamble that you're taking on a adjustable or a variable rate mortgage is significant enough for most borrowers that it could be beneficial for them to take that variable rate mortgage, knowing that there is the possibility of decreasing their interest cost, but more importantly, having the benefit of the more flexibility, a higher level of flexibility in their overall mortgage strategy. And even possibly just consider that if they decided to go with a variable rate, they could lock in at a later time with no additional penalties or pay out 3 months of interest to lock in with a different lender if there was a better term. If there was ever a time to consider the variable rate, the news from just last week suggested that now is the time to consider doing so, and there could be a benefit of going that route. So looking forward, again, what does December hold for us right now? Well, probabilities are over 75% of a quarter point rate drop. Again, we mentioned CIBC and RBC are standing out right now. The economists are saying a 0.5% rate cut is more likely at this point right now. Whether that's just fodder to get a little bit of news or something else, who knows? But they might not be wrong. This is obviously going to come down to employment and what kind of data shows up in the coming month. That will give us a lot of information to see what's happening. And what does this mean for the housing market? I mean, like I said, anecdotally speaking, I've seen definitely an uptick in the last couple of weeks, but I would suggest that we won't see any significant increases in housing until we see at least another 0.5% rate cut, whether that follows in December or January after the new year when we see the traditional run-up of everyone purchasing their homes in the spring. And who wins out on the mortgage options right now? Well, as I mentioned, depending on what you're doing, if you're comparing a fixed to a variable rate, in nearly most simulation scenarios, the floating rate still continues to win on paper, and it does provide that level of flexibility that the average person, especially who's in their beginning of their journey, would appreciate, knowing that if rates continue to come back down, they do have the ability and the flexibility to take advantage of that. So what I'd love to know, though, is from the listeners is, do you think that these rate cuts are going to have a significant impact on, A, the economy as a whole? Will we see this have any noticeable impact on the economy? B, will we see this have any impact on the housing market? Like, are we going to see house prices shoot right back up? Are we going to see multiple offers? Or are people going to continue to wait and then get caught up in multiples at a later time? Or do you believe that with this whole immigration policy change that the demand side is going to go down and we're just not going to see any high levels of buyer demand and the housing market is going to continue to plod along the way it is for the better part of the next 1 or 2 years? I'd love to hear your feedback. If you're following on the podcast, make sure to send me a DM. Oh, yes, and leave a rating if you can. And if you're on YouTube, leave a comment below because I'd love to hear what your thoughts are on the marketplace. Useful comments only, please. Thank you, guys. I'll see you on the next one. That was an unreal episode of The Flow. I hope you enjoyed it as much as I did. on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.